Yeah, so we got a couple of topics. So talk a little bit about what happened in the markets in 2022. Bit of a recap there. Uh, Themes heading into the current year, in 2023, and a little bit about our outlook on what we think is going to happen in the market, and um, some investment themes, the road ahead, where we see things going. And then lastly, we'll talk a little bit about the recent retirement planning legislation that was passed, Secure Act 2.0. It's funny. It's a huge piece of retirement legislation. We'd probably be talking a lot more about it if there wasn't so much to talk about in the markets. And we may actually do a complete separate webinar on it because there's so much to cover. But this is what we got on deck for today. So a little bit about 2022, and we put this in the cover letter for the quarterly reports. If you read the commentary that came out last week, we talked about this. But interestingly enough, so there were 251 trading days in 2022. Ultimately, the S&P 500 was down just shy of 19%. I think the largest drawdown was somewhere around high 20s, 30%. But at any rate, it closed the year down just shy of 19%. And almost all of that downside was boiled down to 5 trading days. So the 5 largest drawdowns contributed to most of the downside last year. So if you took every other day out, they were all awash. And really, the reason we call these out is because the large swings to the downside on these days are similar themes that we see heading into 2023. So, April earnings miss. This was Amazon, big swing and a miss. Amazon, earnings missed expectations by like 15% on that day, which was, and obviously Amazon's a huge part of the market. So that was a major downside. You see, Fed press conference, Jerome Powell, quote in a Wall Street Journal interview where he said there's more pain ahead. So you see a lot of Fed stuff, and obviously interest rates, retail earnings, Target missed expectations, Walmart missed expectations, and then inflation. Once June and September hit, inflation wasn't going away, and the market thought it would. So, these pieces are likely to continue on as themes that we're going to see, at least in the early part, if not for the duration of 2023.
And we're just in the
we're expecting, right?
Yeah, and we're right in the beginning of earnings season too, so we haven't really seen much of what earnings seasons can do to the market. But I think the market's starting to get a little bit of a feel on what is expecting from earnings season this quarter too.
Yeah, so we'll dig into that definitely a little bit deeper here. We have a couple of charts on things, but point is that's likely to continue to be a theme. And then this was the other major thing that does not get talked about as much because everyone is talking about the stock market, but the bond market. It was the worst bond market really in recorded history. This is just going back to the 70s, since going off the gold standard, what the bond market has done. And what you're seeing here is the annual return in the gray bar. So, as long as it's above that zero line, it's positive. So 42 out of the 47 years here, the bond market had positive returns. The red little dots that you're seeing on the bottom, that's the largest decline in the middle of the year. So, and again, typically, bond market is much more placid, a lot less volatile than stocks. So, it might be down 2, 3, 4%, but typically it's up on the year. And only once did it even get close to a double-digit drawdown. Back in the 1980, it was down 9% in the middle of the year, but even then it was up 3% by the end of the year. So again, typically, as we've come to expect, much less volatile.
That's the interesting part of that, Dan, too, is what you identified there is that whole from 1976 through 82, I believe it was. Every single year, it was that the interest rates were going up,
Sure.
trying to slow down inflation through that time frame.
Right.
Somewhat like we have now, and we still didn't spend the returns that we get the losses that we got now back then.
Yeah, and similarly, those were the previous two largest drawdowns, right, in the chart until 2022, which, the crazy thing was the magnitude of the drawdown. We had negative 17%, and it ended the year down 13%. I mean, not only have you not seen, double-digit negatives on drawdowns, but we're talking about the year-end returns was a double-digit negative. So, there was just nowhere to hide, because typically this would be the part of the portfolio that holds up, right, when stocks enter a bear market. So heading into 2023, likely to be similar themes. A lot of the bond market issues are because of the sort of yield curve intervention, the monetary policy intervention by the Fed during COVID, sort of artificially pumping a ton of money in. Now we're on the other end of that, and the Fed and the interest rate hiking schedule are going to continue to be a large, or probably going to continue dominating, to be quite honest, most of the conversation. Corporate earnings, you mentioned, Rick, they're coming into focus a little bit. Inflation is still on the docket as an issue that has to be contended with. Part of that coming from the labor market and wage growth. And then lastly, it's, we're going to continue to see, I mean, we've seen it now, but we're going to continue seeing sort of all the speculation around recession. What's it going to look like? How deep, how long, that kind of stuff. And, because around the recession, we're seeing that pretty much every single outfit is above a 50% chance this year, from what we're seeing, right? Like most economists and researchers and forecasters are saying, that there's a better than 50-50 chance that we're going to slip into a recession at some point this year. So yet to be seen, but likely to be more coverage on that.
I think if we do slip into a recession this year, especially the early part of this year, it'll be the first time in history that more than 50% of the economists out there actually predicted a recession.
Well, that may be true. That may be true.
I just read that the other day.
The old adage goes that economists have correctly predicted 9 out of the last 5 recessions. So we'll see.
That goes along with the economists are always right.
Right.
Exactly. If what they say happens.
Right.
Sorry, didn't mean to mess you up there.
So the major, and we've talked about this a lot, but the major theme with the Fed right now and the rate hike cycle is, when are they going to stop increasing interest rates? And this just gives a little bit of background to why the market seems to think a pause is on the horizon. So as of now, the Fed is planning 3 more hikes. Those are quarter percent, 25 basis points each, which would be a 0.75% hike in total. And that'll be over the next 2 policy meetings. Typically, over the last 9 cycles, I believe this is 9 rate hike cycles, the Fed will not pause. In other words, they will continue hiking rates until the federal funds rate, this column right here, is greater than inflation. And then in 2012, the inflation measure went to core. And one of the major questions is, will the Fed look at core inflation or will they look at headline inflation? Because the two do, they differ quite a bit. And right now, either way, as you can see, the rate, the federal funds rate, target rate is about 4.5%, both below both measures of inflation. So this is why the Fed is continuing to hike. Now, at the same time, we have inflation falling a bit. So as the two, continue to converge, there's a good argument that once that happens, the Fed will have enough confidence to stop hiking. And as of now, that looks like what's going to happen after the second policy meeting this year, which I believe is the March meeting. Okay.
So we got, you just said the March meeting is when you believe they're going to stop hiking. So
Right.
they expect 3 more hikes this year is
yeah,
what's
I think
in
it's
the
supposed
expectations.
I think it's supposed to be 2 hikes, 2 this month and 1 in March is I believe what they're planning.
2 this month. Okay.
Yeah, I think January is the Fed meeting. So I think it was 2 at the first meeting, 1 at the second meeting, which I believe the second meeting is March. I'll have to check that, but
yeah, we got okay. February, March, I thought is the rate hike opportunities.
Or February,
and maybe one,
March,
one without a Fed meeting, they can do it, I believe, in this month. But yeah, so that's to be determined depending on where Jerome Powell ends up going and where the rest of the Fed ends up going. And that has a lot to do with some of the things you're talking about, inflation that we saw yesterday coming down a little bit. And the big thing is wage growth that we're going to talk about a little further up here. So,
yeah. And so, here's why we are, I believe, hearing a lot of chatter is the market is looking forward to the Fed cutting rates. And I think the reason is the market would love to get back to, I don't think we're going to get back to the near zero rates, but the market wants to get back to cheaper money. Simply because there's easier growth with cheaper money. And what this is showing is technically a rate cut, which typically follows a pause, right? So you have, essentially a cycle of hiking, they stop hiking, and then an indeterminate amount of time later, right? Sometimes it's 5 months later, sometimes it's over a year later, eventually rates start to get cut again. And what this is showing you essentially is, if you focus on the column on the right, if you were in a recessionary environment, which that's kind of what we're staring down the barrel of a recessionary environment.
So they say.
Rate pauses and rate cuts in recessionary environments do not necessarily spell positive stock returns, even though they're going to create optimism. If you parse out the non-recessionary periods, then the pause and the cut cycles during a recessionary period are actually more in response to the economic weakness, and typically do not necessarily mean that the stock market will, follow suit, and you're going to have all this cheap money out there that corporations are going to be able to continue growing. So really the point of this is that you typically have more optimism around a pause if you look at the average returns 6 months out, 1 year out, 2 years out, versus after the cut. And really the reasoning is, a cut happens in response to a weak economy, which creates a less rosy outlook for stocks.
And the difference we have between this chart and where we are today is, in a lot of cases, which we don't see here, is as interest rates start to go up, it's mainly because the economy is doing well. So that's positive for the stock market, and the stock market will continue to rise in a rate cut environment. Where this time it didn't. This time inflation hit with aggression. A lot of it was originally thought to be transitory, and still some of it is transitory. But it came with aggression, and so the Fed rate hikes were done at a much more aggressive pace than in past history. I think the last time we increased with this aggressive pace was back in 2000. 90, it looks like 99 to 2000.
Yeah, and then the pause happened right here, May 2000.
Yeah, it's actually 94 to 95. I'm sorry. So and then the pause, go back to 94, 95. Where was the pause there? So it was February of 95, and then the rates, then the market actually did well.
Yep.
But at that point in time, we weren't in an aggressive inflationary environment. They were just trying to slow things down, and they were anticipating rates continuing to come down. The Fed made a different move. And back then in 95,
to your point, not a recessionary environment.
It wasn't. Well, no, I'm sorry, not an inflationary environment through 92, 94. I'm sorry, 94.
Correct.
Not inflationary environment. The Fed makes, and back then the Fed didn't announce the changes either. They just did what they did, and it surprised the market, and the market reacted. Now they're a little bit more, not a little bit, a lot more open as far as what they anticipate doing. Basically throwing out warnings. But this is a very different market than what we had in the past, because of the market ending on, or not ending, but going through a downturn at the same time that they're increasing interest rates. And that doesn't typically happen in this environment.
Yeah, well, and you said they're throwing out warnings. So this is kind of, to be quite honest with you, it's kind of gibberish. But I'm going to attempt to translate it. So this is a direct quote from the meeting minutes of the Federal Reserve policy meeting last month. And essentially, the operative term here is that monetary policy works importantly through financial markets. And if you read through this, it's just, like I said, it's almost gibberish, but essentially what this is saying is that when the Fed does pause, not if, but when the Fed does pause, or, when rates get cut, or, when the Fed announces a pause or a cut, if they see rallies in the stock market in response to their interest rate decisions, they are going to take that into consideration. And essentially what that means is, if there's a stock market rally, the Fed is going to look at that as a direct contributor to inflation, and it's going to give them more reason to remain hawkish. So the market is trading on every word of the Fed. So when there's something that looks like they're going to ease up a little bit, the market's popping up aggressively. And essentially what these meeting minutes have said, which is really quite interesting, because this is the first time they've ever directly addressed what's happening in the stock market. The Fed is saying, we're watching the market, we're watching the stock market. If we see pops in the stock market in response to what we're doing, it's going to give us, no pun intended, but it's going to give us pause in following through on those policies, because they do not want to see market pops in response to these rate pauses and rate cuts, because they believe it's going to continue to fuel the problem.
And it will, because a lot of what fueled this market now was aggressive market runs. since 2020. Easy money policy and a fast market move basically started to fuel aggressively this inflation environment now that we're in. So
Yeah, and I think, so it's interesting that, that they're addressing this, right? But, B, here's, I'm gonna just quickly, and we can kind of talk through what this means, but just to give an idea of what we're looking at here, the chart on the left-hand side, this is what they call the dot plot, which each dot is one vote of the Federal Reserve Board of Governors. And then you're looking at 2022, 2023, 2024, 2025. And what this is basically showing you is that there's a general direction of where the Federal Reserve believes rates are going to go. They're going to raise them, as we talked about, right, in the beginning of 2023. And then over time, they will go down. But the interesting thing here is you can see even next year, there's a pretty wide disparity on where they think they're going to be. And, just go 1 year out in 2024. I mean, nobody is agreeing on where they think rates should be. It looks like they generally agree that they probably are going to cut, but nobody really has an idea of how much. And the market, if you look on the right, the right-hand side, the blue is that line I just talked about, that what the Fed is expecting. The market is the green. So the market is betting that the Fed is going to essentially lose its nerve. The Fed's going to be chicken and they're going to start to decrease rates. And to me, after the meeting minutes have reflected that, essentially, hey, we're watching the stock market, and if we see rallies, we're going to try to squash them with our policy. And the market is betting and saying, yeah, no, you're not, I bet you're not going to do that. We're going to expect rates aren't going to increase as much. That's setting us up for some major volatility, because it tells me that the market is eager to kind of get out of the woods, and the Fed is saying, like, we're not even close. So you're going to start to see pops because people are optimistic. They're going to get shot down because interest rate policy isn't moving as fast as people thought it was going to move. So, I think that this is kind of setting up a little bit more volatility around the things we talked about at the beginning, which is every time the Fed says something, you could get a move 3% up, 3% down, and that could end up, really telling the story for the year. And technically over the next couple of years, because there doesn't seem to be any consensus on where rates are going. And this is not my own, but I heard this somewhere and I thought it was a good point. When you don't have a real consensus on what the benchmark interest rate should be, it's incredibly difficult to price any asset across all financial markets. So that means, stock markets, bond markets,
housing,
the real estate market. It's very hard because you don't know where rates are going to be in 2 years. So I think this is probably the biggest story out there, is there's just complete dissent amongst the policy setters, the market, and the expectations are just disconnected.
Yeah, but what we do know is we've been here before, and we've been comfortable with interest rates at this level. In purchasing houses and the economy's continuing to grow. The rate level that we've come from has been, it's more of an addiction, I believe, that people were addicted to these low interest rates and buying properties and utilizing their cash flows to continue to buy more properties. So this, the difference between the housing market this time and the housing market last time is the housing market was truly fueled by low interest rate, high stock markets, and easy money. In 2007, 8, 9, the crash was fueled, or the growth of the housing market from 2003 to 2006 was fueled by easy access to money, where more people had availability that really couldn't afford to buy into it. And also interest rates were low at that point in time too. But so it was lower interest rates and easy access to debt. And that fueled the explosion in the market in 2007, 8, and 9, where we don't have that this time. We don't anticipate housing market dropping off aggressively, although it will drop off. But we don't anticipate it dropping off aggressively. And this also fuels the scenario that the Federal Reserve actually can hold out and keep interest rates at a higher rate, maybe even above that 4.10 for a little bit longer.
Yeah, well, and to your point, unlike, 03 to 06, like this next recession will not be because of a structural issue. It's going to be because of a like essentially what I just said,
Forced.
a asset mispricing issue. Like nobody knows what the benchmark rate is going to be, what it should be, and it's aggressively increased over the course of 12 months. So it's forced, and it's just creating essentially speculation, and there's a ton of disconnect. So it's, again, likely not to be a structural issue that's going to throw you into like an unmanageable bear market, prolonged recession. It's likely to just be cyclical.
So
Right,
the last time we were buying houses at a loan rate of 2.5% was 1962.
Yeah. Yep.
Yeah.
Yep.
So that was in an article not long ago.
I had it in here. We can zoom past this.
Oh,
Or you know what? Let's address this, because I got something on shelter in here. I think it's the next slide, but
it is.
Let's just real quick, we can address this. So earnings, let's just address earnings, because again, this has everything to do with interest rates. So this breaks down corporate earnings very simply. There's basically two parts to corporate earnings. There's revenue, which is the green, and then there's profit margin, which is the gray. Okay. And what you're going to see in 2022 is the total of those two was actually negative. So corporate earnings took a little bit of a hit, -4%, but revenues were up close to double digits, up 9.3%. All of the earnings compression that we saw in 2022 was due to margin compression, and it's essentially directly related to the cost of capital. You have interest rates aggressively increasing, and there's just, stands to reason there's going to be margin compression. The save for 1 year, I think 2015, there was also margin compression. But if you look back to the last two sort of cyclical recessions, you had margin compression at the same time that rates were increasing in 2001. You had margin compression, rates were increasing, 07, 08. And again, in both times, what did you have right afterwards there? And same thing in 2020 with COVID, right afterwards, you had, this tends to be a leading indicator of a recession, because it stands to reason you have a rate hike cycle. Margins start to get compressed. Corporations have been, adding debt, adding leverage, because capital was cheap. They've been funding projects for growth. All of a sudden, you get whipsawed the other way. Margins get compressed, and now all of a sudden your earnings aren't looking quite as good, and it tends to indicate a recession is on the horizon when this is happening during a rate hike cycle. So I just wanted to point that out, and this is likely to continue to be more of a topic, I would say, this year than last year, right? Because we're still hiking, and earnings season is going to be starting, and I think we're going to probably have some more misses. Analysts have already revised down most of their expectations. So,
except for Netflix, of course.
Except for Netflix, which doesn't make any sense to me.
Just came out with their expectations. They're up 20 after market. Just saying.
Yeah, that's setting up for disappointment. But so this was I think our third theme for this year. Again, persistent inflation. I think it was just, we just saw the November numbers come out. It's down to 7.1 off of 9.1. So trending in the right direction, but interestingly, it's still the same place it was a year ago. In fact, it's a little bit higher than it was even a year ago. And again, the interesting part here is we keep talking about transitory inflation. Well, the transitory parts, the new and used vehicles and energy back here were, over, well, at least half of the inflation. And now you see not much at all. And food, shelter, and then this restaurants, hotels, and transportation makes up a much larger part of the inflation. And I think this is what's kind of concerned the Fed. And Rick you were talking about the housing. I mean, that's been such a major contributor. You see the dark blue bar here. The housing component has just continued to climb. Right.
Yeah, and that's a laggard.
That's the only thing that would suggest that maybe the Fed is overcorrecting, right? Because I think that's like a third of the inflation component index, and it lags 12 months. Right. So you're seeing stuff in that in the shelter component that was like, if it was from December of last year, it's still showing up in that shelter index. So we should continue to see some positive signs on the inflation front, because we know in real time that the shelter costs, the housing costs are going down, but they don't make it into the inflation data until 12 months out.
And here's the other interesting part to your chart, Dan, is the light blue area where it's restaurant, hotels, and transportation. A lot of this increase is not only due to, and technically an inflationary environment, but it's due to mandatory increase in wages. Where a couple of years ago they started pushing to get the minimum wage level up from 7.5 to, I think, 7.50 up to 11, then 11 to 15. And I think this year we're at 14, and next year we're supposed to be at 15. And that's going to push prices up because they have no other choice.
Right.
And as long as there's capital out there and people are going out to eat a lot more, and also there's labor shortage in that environment too. And that's also going to push things up. I know on one of the boards that I'm on, one of the things we're talking about is our labor environment there. And currently they're at $14 an hour, and they're getting people to leave because they're getting $1 more an hour. Now, what they're looking at doing is increasing up to the minimum wage and then pushing it actually up and over into the $16, $16.50 an hour rate, just so we don't lose people. Right. So that's going to put a lot of pressure on that area of the inflationary environment in that area of the market as well. So your food prices can come down a bit. Your new and used car vehicles can come down a little bit. Even energy can come down a bit. But you're still going to have an inflation in that environment. Plus, you got your laggard in your shelter. Right.
Yeah, and here's the I mean, the kind of good news to that is this typically is not a long lasting thing. And what this is, and we've looked at this chart before, but you're looking at the unemployment rate and wage growth. And Rick, you noted, so 50-year averages here, right? Unemployment 6%, wage growth 4%. Right now, wage growth is close to 6%, unemployment's down at about 3.5%. So both are, wage growth well above its long-term average, unemployment well below its long-term average. And typically, historically, when these things sort of butt up against each other like this, even during COVID, when they start to butt up against each other, those are a recession is soon to follow. They typically bounce off of each other like that at the end of the cycle. So at the end of the economic cycle, unemployment is low, wage growth is high. Only one other time, now we've completely inflected, right? These aren't bouncing off of each other. They've crossed over. Those lines have crossed over. The only other time this has happened was, again, back in the 70s and early 80s. This only really ever happens during inflationary times that they inflect. And again, 70s and 80s, you had a couple of recessions there because of the issues with inflation and the interest rate hike cycles. But the point is that this is a very consistently a consistent metric that will tell you that you're at the end of an economic cycle, right? And that wage growth that's helping to fuel inflation essentially will continue to fuel inflation until it doesn't. Right. And that's what this chart is showing you. It's essentially taking that whole thing and it's showing you the number of job openings to job seekers. And this peaked about 4 or 5 months ago. I'm going to draw a circle here around it. You can see the peak there. So there we go, right there. So back in, I believe this was September, for every person looking for a job, there were 2 jobs, right? It's never been that high before. And the point of this chart is not about the level. It's about, if you look at the trend lines, every single time this peaks, every time it peaks, what happens next? Recession. And it's not to say that it's an exact predictor of a certain number of months, or, is it going to take a year? Is it going to take 2 years? Is it going to be 3 months from now? We don't know, but every single time that gets to a cyclical peak, there's a recession on the horizon. And this is another indicator in the job market, in the labor market, that a recession is due. And the Fed is going to continue increasing rates until they can essentially choke it off. They're not going to say it, but the Fed wants to see unemployment go up, technically, because they know that wage growth is helping to fuel inflation.
Yeah, that's it's an interesting chart, because you look at that, it's 1977, you didn't see the recession hit until mid 79, early 80, I think it was. And then again, the same thing for 88. It peaked and we didn't see it happen. We didn't see a recession happen until 90. So this could potentially show that we don't have a recession until 2024. It's possible.
Oh, it's certainly possible. And I think, again, it really, there's a lot of things that depends on, but what this is the technical recession definition. This is like the heat map. And, one of the things that we are seeing is that as of, I believe this was the end of November numbers, retail is negative and industrial production is all but flat, right? So again, in an inflationary environment, that tends to be a leading indicator, because it's saying, retail sales are down and industry is flat. The only thing keeping it up is consumer spending and real personal income less transfers, and as well as non-farm payroll employment. So again, we're basically talking wages here, right? And spending. That's what's propping up the economy at this point in time. It has nothing to do with wholesale and nothing to do with production. It's just straight up spending. And it stands to reason, because consumption is close, almost 70% of GDP, right? So as essentially, as long as, I love the saying that the American consumer is remarkably resilient, right? Because as long as there's money in your pocket, you're going to spend it, right? And there's still money in the pocket. There's still wage growth. There's still a lot of job openings out there. And that consumption piece is a major part of GDP. So as long as there's a strong labor market, whatever the Fed is doing, sure, it's going to move the stock market. But if there's a strong labor market, then we're really not going to slip into a deep recession. The question is, if you start to see the Fed's interest rate hike policy creating margin compression, and you start to see layoffs, right? So, and we're already starting to see that. I think Amazon is planning its largest ever layoffs, and it's starting at the top. These big companies are doing their biggest ever layoffs, 10,000 employees here, 100,000 employees there, right? And then all of a sudden, the American consumer has less money in their pocket, and industrial production is flat, retail sales are down, and this spending number starts to come close to zero, and this real personal income number starts to come closer to zero, then essentially that right there, that consumption number, that's the last domino to fall, and every other piece of it throws everything into a recession. You still have high costs of capital, and you still have inflation. Right. So this is the very last piece, and this is yet to be seen. A lot of this hinges on, again, when we don't know the answer until it happens, is the Fed being too aggressive? And is the Fed going to pause sooner than later? Is the Fed going to cut? Is the, all answers that we don't know. What I can say is that it seems that the probability of a soft landing is getting slimmer and slimmer by the day. Simply because I think if you continue to see these layoffs, the consumer spending, the consumption part of GDP is going to have to contract. And that's going to mean we have to go into a recession. And the question is, will they just kind of let up on the brake pedal, just soon enough so as not to come to a grinding halt?
Or
right?
The alternative could be is they do pause. So far, the Fed has done exactly what they said they were going to do.
Right.
And the anticipation is that they're going to continue to do exactly what they're going to do. So 3 more rate cuts at 25 basis points. What we're starting to see now is the Chinese economy starting to pick up. And we're starting to see the dollar fall off a little bit, which actually could have a positive effect on earnings, especially for foreign and companies local to US that do foreign business, could ultimately have better earnings just because of that dollar drop off. And then with China picking up in their economy a little bit, also could actually bring us into a soft landing. And
it
also
could help globally. I don't know if it would help the US. I mean, the rest of the world is further along in the business cycle. We know. So it may help in the sense that, if not everybody's down, it may help, because most of these companies are multinational now.
right.
Yeah. So this was just simply saying that we're at a trough of consumer sentiment. So typically what happens is when consumer sentiment gets low, the market tends to do well afterwards. And really it's just because people, essentially people are eager to kind of get out of the woods. This to me says we saw a drop, and now it's kind of gone up sharply. This is just evidence that I think investors are eager, and they're hanging on the every word of the Fed, and they're saying, yeah, there's going to be a pause. Let's get the money in because we're going to get back to where we were. My attitude is not so fast. We still haven't had the recession yet. There are still fundamental issues in equities that people seem to be ignoring because they are just laser focused on how the market has operated over the last 15 years, which is cheap money equals returns. And we're not that ship has sailed. So I think maybe a little bit the market's getting out over its skis, but it's yet to be seen. It depends how bad the impending recession is. And I just wanted to, because we're kind of gearing more towards a lower for longer type of environment. And I wanted to show, so this was the returns needed to get back to the stock market peak. And this to me was what, it's kind of, it puts it in perspective. If you were to average a 7.5% return on your stock portfolio, it would take 4 years to get back to the previous peak. And to me, something like that is a very feasible outcome moving forward, simply because if we have this higher cost of capital, even though the Fed seems to agree over the next 3 years, rates will come down, they're not going back to where they were. And, you know, if it's going to take sort of a recession to kill the inflation fires, how are we going to get more than an average 7.5% out of the stock market at large, you know, over the next 4 years? Because we're not going to work this out overnight. It's not like it was, again, think about COVID, when they just injected a ton of money into the system and we had a 1 month bear market. Like that's not going to happen again. In fact, it's quite the opposite. So basically, you know, our guidance right now is a bounce. We don't really expect a bounce back. We don't see a catalyst for I don't think a Fed pause on rates is going to create a giant bounce in the market. And if it does, it's possible that there is, you know, more downside ahead. You know, the major thing is stay invested, but quality, meaning we need to be laser focused on fundamentals, not market timing, not speculation. And, you know, we still believe that the, you know, quality dividend stocks with quality cash flow, high profit margins, you know,
income, dividends, income.
You know, U.S. Treasuries that are yielding 4.5% plus over 1 to 2 years. You know, we believe that those are still the best places to be. You know, speculative investments, high yield bonds, really growthy stuff. You know, just it doesn't seem to be high flying tech names. Don't seem to be, you know, where you want to be right now because the cost of capital is going up. So, you know, we still think the best offense is a good defense, so a more defensive strategy, but to remain invested because the markets always price in a brighter tomorrow. And typically the first half of the bull market returns almost twice what the second half does. So you want to be in at that turn. We talked about those 5 days this year. Well, the opposite happens. When you start to see a turn, you're going to have days where the market just pops 4 or 5%, and you want to be in. You can't try to time that. If you missed it, the train has left the station. So you got to make sure you're staying in, because that's impossible to know what day you're going to get that pop.
So the question is, the big downside that they're all projecting out there, will it get back to where we were in I think it was our low in October?
The low in October.
Yeah. So they're all the consensus is out there is the market's going to drop, which it has been. But our low was in October.
Yeah.
So the question is, will we get back to that low? If we get back to that low.
Yeah, it's a good question. I tend to think it has everything to do right now, at least, with this disconnect.
Yeah. So if they stay higher, or, you know, yeah.
I think that if the Fed remain, even if they pause, if the Fed remains elevated and doesn't cut, I think the market's going to be disappointed.
Yeah. So by the end of March, we're now through dividend season, and then dividends are going to play their toll on the stock market in general. And the rates don't get cut by the Federal Reserve because they continue to do what they say they're going to do. That's where our drop's going to come in. And then when they pause,
I think it's possible, and I don't know if we test the lows again.
Yeah, I don't think we do either.
It's hard. It's hard to say whether or not that happens, but there could be a drop. You know, but it's funny because a lot of the you know, we were talking at the beginning how a lot of the economists and researchers are saying there's a better than 50% chance. You know, even those same people in the same breath turn around and say, but we still think the S&P will be slightly positive this year, which, if you kind of read between the lines, what they're really saying is we expect a drop and then we expect a bounce back, which is kind of odd because I'm not sure where that bounce back comes from, but I think that they're assuming there may be a rate cut.
Yeah, no, I think the bounce back is actually coming from the pause because
Yeah, it
we've
could be.
done,
It could be.
because the market reacted so differently in 2022 to rate increases. I think
Right.
that the breather and the sigh of relief is going to come at the pause,
Right.
which could
Yeah, and
be
by the way,
the end of
when I say
March.
don't expect a bounce back on this slide, it's, we might have a pop in the market. It's don't expect the market to just get back to where it was.
Right.
Because again, from the previous slide here, that would mean like a 25%, 26% return. Like, we don't think that's going to happen.
So statistically speaking, when the NASDAQ dropped in 2000, it dropped about 60%, I believe, if I remember correctly, between 2000 and 2002.
Right.
And it dropped over almost a 3-year period, 2.5-year period. Never got back above where it was until 2013.
Yeah.
So that's a long stretch for that to come back. The S&P 500, when it dropped in 2000, it started dropping in November 2007. When that dropped down between November 2007 and February 2009, it never returned to the original high until 2013.
Right. It was 6 years. Right.
Yeah. So
and again, I could see that now for the NASDAQ, like 01, because I think that part of the market was more of a bubble than the broad market at large. But the tech names that just were addicted to the cheap money and just couldn't get enough of it, right?
Well, I also heard a philosophy. We gotta keep moving. But the philosophy was that I heard the other day was when 2020 hit, when the market dropped in 2020, everybody went out of work. A lot of those tech companies, Amazon, Apple, Microsoft, a lot of the cloud services, the Zoom technologies, things like that, all pulled 2 years of profitability forward. And that's what caused the big run up. Now they've dropped down fairly aggressively, which was, I named three of them, which was the Amazon, Apple, and Microsoft were the lead reason why the S&P has gone up so high.
Oh yeah.
Three out of I think 4 or 5 or 6 stocks at that point. Google was another leader to that process. And they don't expect that to come back again at the level that it has. So being selective, like you said earlier, Dan, being selective on the types of equities you buy into, high cash flows, high free cash flows, strong balance sheets. They don't have to rely on their leverage, good dividends. They're all areas to be in, because those areas may not encompass the entire S&P 500. So good quality stock picking, good quality mutual funds that we can get into is, I think, the key factor to getting our growth this over the next couple months, 6 months, next couple of years.
Right. Yeah. For the foreseeable future, let's put it that way, until things change. But
and just an announcement: if you guys want to start putting questions in, Dan will go through this pretty quick, and then we'll go over some questions towards the end here.
Yeah, there's a Q&A or a chat. I think you could put it in either one. But this is kind of it really is not a footnote. It just kind of feels that way with everything going on in the market. But so the Secure Act 2.0 was recent, as it's called, was recently passed. It's probably the biggest retirement legislation in the last 20 years. And it expands on the original Secure Act. One of the major things, and some of these, we have some time to kind of digest. They don't all go into a place immediately, but there are, as you can see, some provisions effective this year, next year, 2025, and even 2033 based on the rules. But the major ones that I wanted to point out was there are no new RMDs this year. So if you turn 72 this year, you actually don't have to take an RMD until next year. So you get a 1-year reprieve. And if you turn 73 in 2033, you actually will get a 2-year reprieve, because the RMD age will be increased to 75. So they're kind of creating like a bracketed system, almost like Social Security, for your required distributions. Another piece here, next year, if you are doing catch-up contributions to your retirement plan and your wages are over $145,000, you must make those catch-up contributions as Roth. So no more tax deduction. And then 2025, if you're doing catch-up contributions, once you turn age 60, that limit will be 50% higher. So they're adding another bracket, if you will, to be able to make retirement contributions into your 60s. Another piece that I think is incredibly interesting, so we have this conversation a lot and it's becoming a little bit more clear, but not something that we're going to be able to really utilize until next year, is if you have extra money in a 529 plan, your son, your daughter goes to college and they don't use the entire balance in the 529, it's overfunded. You will be able to transfer that money tax-free into a Roth IRA. And we can talk through specifics, but essentially there's a lifetime limit on how much of that you can do. And it would be a multi-year process, but that they're kind of giving a safety valve for extra 529 money, and that can be transferred to the beneficiary. It can be, you can change the beneficiary and transfer it. So it'll be an interesting to see how that plays out. And there are, we kind of distilled this down to what we think is most applicable to our clients. There are a slew of other regulations as it pertains to if you're a small business owner and you have a retirement plan, there are a slew of other regulations too. But these are probably the big ones. So if you have any questions, let us know. We might even do a webinar just on this because it is a major change. I think that's all I got. So
I believe we have a couple of questions and we might be able to take one or two. Let's see. When we go, let's see when, so the question is how long do you expect this lower for longer to go? And I got a follow up to that.
Yeah, it's it's hard to say. I think that my best guess on how long I would expect that to go is until the market can understand where interest rate policy is going to be. Like I said earlier, it's very hard for anyone to properly price an asset across any financial market when it's completely unclear as to what the benchmark interest rate is, 3 months from now, let alone 3 years from now. There does seem to be consensus among, the central bank and the market that, 3 years from now as to where that rate's going to be. So my guess would be the lower for longer is going to last for at least 3 years, and then the question becomes, as you're in that time frame, what's happening with inflation? Is it starting to go away? Is it remaining elevated? Where's the labor market? And obviously there are other, geopolitical events that can happen. So I think for me right now, I look at that and say we're going to have lower equity returns for the next 2 to 3 years, and then depending on what happens during that time frame, it could be lengthened, and it's yet to be seen. But as of now, that would kind of be my thought process.
Okay, and that follow-up question is, if I'm taking income from my portfolio now, how is lower for longer going to affect me?
So, yeah, I would say I would go back to the quality argument, which is lower for longer doesn't necessarily mean that we're not going to have periods of good returns, but it does mean that there is likely to be some volatility, and creating liquidity for income purposes is going to be more difficult because it will require essentially timing. So the quality is very important because, you want to be able to generate income off of dividends. You want to be able to generate yield off of your bond portfolio. So again, using treasuries while the rates are so attractive, using, you know, higher quality corporate bonds while spreads are attractive, not going into like high yield bonds or growth stocks and expecting that that's going to help fund income. So I think it goes back to a quality argument, which is to say, you need to be able to weather the volatility in the market by creating more consistent, more consistently predictable income from what's in the portfolio, not from, you know, selling assets.
Right. And I would say, I would add to that too, the average portfolio, especially that we oversee, is taking about between 3 and 4% from their portfolio. And right now, your average dividend portfolio is running just about 3% and increasing on an annual basis. And the dividends, actually, the dividend stocks that we look at, have increased every year over the last 15 years. And that's through actually the last 20 years. And that's through, at the most part, 2007, 8, 9, when we had a structural issue in the market. So good, strong dividends continuing to increase. And then with the income being above 4%, or 4 to 4.5%, sorry, on the income treasuries. Yeah, you got, you know, you're still above what your average portfolio is being pulled from. So we still got a slight growth in there. Plus your growth from your stocks could add to the increase in the value of the portfolio as well. One more, this is a good one because I heard this one already. When do we go on the offense versus defense? We play defensive all the time.
Yeah. You know, and we tend to be a little more cautious by nature anyway, and long-term kind of, long-term, you know, buy and hold. But to be honest, I think you go on the offense a little more when there's two things: when there's a little more predictability, again, i.e. what's the benchmark interest rate and where is it going to go, number one. And number two, when you're not staring down the barrel of a recession. And we've been staring down the barrel of a recession for several years now, and it hasn't happened just because of central bank intervention, and honestly due to COVID was mostly the reason. We were kind of on the precipice, and then the intervention popped us out, and we're now kind of back to paying the piper. But you know, ultimately I think that it's something where you can start to play offense a little more once the recession starts to run its course. And, you know, we still like the quality idea, which tends to be a more defensive strategy, but we still like the quality idea when it appears likely that we will experience a cyclical recession, you know, in the near term. You know, but what that means is when you start to see treasury, the 1-year treasury no longer yielding 4.5%, and all of a sudden those rates crater and the yield curve is no longer inverted and the market is down. I mean, what that basically means is if you're no longer getting paid to wait, then that's when you start to play offense. When asset prices are depressed, when you're not getting paid to wait, that's when you buy in. So it's not time yet.
Okay, that was a great answer. And our ultimate goal, as you said already, is protect the downside first, because it's harder climbing out of a deep hole than it is.
Well, and you talk about it all the time too. We haven't reached capitulation.
We have not reached capitulation.
We're almost the opposite. People are eager to get back in. People are eager. Like, we're not to a point where people are like, I gotta bail. We never got to that point.
Nope.
So usually capitulation is when you start to play offense.
Yeah. So which we will see.
Focused on a smaller hole, bigger shovel.
So thanks, Dan. It was a great presentation you put together and a great letter that you put together that really identifies the way we think on a regular basis.